Hello and welcome to today's discussion, RegTech Tools for the LIBOR Transition. My name is Manesh Samtani. I'm the editor for RegTech Asia. In recent years, the financial industry has slowly come to terms with the fact that LIBOR, the most widely used interest rate benchmark in financial products for decades, will soon be coming to an end. And with hundreds of trillions of dollars tied to LIBOR, it's no surprise that the transition is considered one of the biggest challenges the financial industry has had to face in modern history. So today, in line with that, we have four industry experts to discuss with us the progress that has been made so far, what still needs to be done, and how technology can help to facilitate transition efforts. So I can see Jing from ISDA is not here yet. So it's moving on. We have Dennis Ko, who leads Bloomberg regulatory data business for the Asia Pacific region. He's overseeing the development of new data sets, response to changes in the regulatory landscape, including for the LIBOR transition. So he's been working with banks to address key issues relating to testing plans, risk assessment modeling, and so on. Welcome, Dennis.
Good afternoon. Hello.
Thanks. Cool. Next, we have Natalie Curtis, partner with international law firm Herbert Freehills. Natalie has been working with various financial institutions on their LIBOR transition plans, regularly interacts with regulators, industry bodies, market participants. Welcome, Natalie, and I understand happy birthday is in order.
Thanks, Manesh.
No worries. And finally, we have James Ient, CFO at Tradition Asia, a global interdealer broker with offices spread out throughout Asia. So James is responsible for the setup and operation of Tradition's various Asian businesses with departmental oversight in finance, compliance, risk, legal operations, HR, and so on. Welcome, James. Happy to have you.
Hi, everyone. Happy to be here.
Thanks a lot. Before we kick off, I'd like to remind the audience to feel free to submit any questions you have throughout the discussion. We'll try to get to some of them during the discussion and perhaps towards the end in the, limited time that we have. And if there is anything that we're not able to get to, we'll certainly try to address those questions by email or by chat throughout the day. So first off, I'd just like to kind of give Natalie the opportunity to maybe kick off the discussion. I know, Natalie, you've been working with a lot of these banks in Singapore. I know, first off, it's important to say that industry progress is measured differently based on what jurisdiction you're in. You know, these differences seem to be more pronounced in Asia, but Singapore in particularly seems to be considered a front runner in the region when it comes to the LIBOR transition. So Natalie, could you give us kind of a brief overview on sort of what the banks have been working with, have been doing so far, what their priorities are, some of the key challenges you see, and maybe expand into what you're seeing in the rest of the APAC region.
Yeah, sure. Thanks, Manesh. And look, I mean, I think that LIBOR has really become the sort of the Y2K topic of 2020, sitting alongside COVID. It's a tough battle depending on where you're sitting, but it's been something that has been a long time in the making. It was announced some time ago that the banks would be required to submit for the LIBOR calculation from the end of 2021. Now that seemed a really long time away, but as now with most of us working from home, the days kind of roll into one and we're already into Q4 of 2020. So for some, of our clients, it's now sort of starting to reach a slight sort of panic, situation in that, because I think time is one of the biggest, concerns. So with COVID, everybody's been busy trying to address that. And I think there had been some hope that there would be an extension of the LIBOR deadline, but both the Bank of England and the US Federal Reserve have made it clear that the end for LIBOR, or the end for sort of compulsory submission, is 2021. So I think Singapore and Hong Kong within Asia, there is a good level of understanding of what needs to be done and what is happening. there's, particularly within the banks, within the sort of, the corporate world, less so. There's still a big education piece going on there. But some of the other markets, which also have, local benchmark rates that may also use LIBOR in the calculation. So, in Singapore, we have a SAW, which uses US dollar LIBOR in its calculation. So hence, there being changes afoot to move to SORA. And some other jurisdictions, Thailand, Philippines, and others, there's also similar local benchmarks where they need to be looking at transitioning away from those because they'll be affected by the discontinuation of LIBOR. But the issue there that we're seeing is that, this is sort of only starting to come on to some the radars of some. So they're less, I guess, organised in that respect. In terms of, I guess, some of the challenges, this is, it's a huge task to even identify the full scope of the project in relation to the transition of LIBOR. So for most of our clients, we've seen them sort of put together working groups and that, and identifying a senior manager to sort of take responsibility and to report to the board and to the rest of the senior management. There's a lot of, sort of oversight from the regulators. There's been numerous surveys in that have required banks to submit a huge amount of information and also explain what their transition plan is. So they've had to put together those submissions, but also just identifying the products that are affected, the clients that are affected, the systems. I know this is a RegTech, sort of themed conference, and technology plays a huge part, both in terms of the changes that need to be made to, so many different systems. And I think part of the problem is we haven't yet necessarily settled on exactly what the solutions are as well. So there's some sort of difficulties around that. And then there's the client outreach as well, which as I said, the education piece is something that is now becoming even more important. I think with some of our clients, they weren't exactly sure what they were supposed to be saying to their clients, because the solutions and that weren't necessarily in place. But now I think, some of the alternative reference rates have now been identified. There's transition plans and that. So, I think some of those question marks now are, we've got a bit more scope and a few more answers so we can move forward.
Thank you, Natalie. You've covered a lot there. So I guess we're talking about huge operational challenges. We're talking about potentially slower progress from maybe smaller markets. You mentioned Thailand. I know Thailand. They just completed two of the banks just completed the first overnight index swap transaction just earlier this week. And I understand, James, you were part of your firm Tradition was the arranger of that deal. I don't know if you can tell us anything about that and sort of share a bit about. I know there were some technology aspects that needed to be addressed. I don't know if you can share a bit about that.
Well, I think in most markets, the background from an IDB perspective is twofold nowadays. If we go back to the polled benchmark status of many years ago, where LIBOR is one example, but there's some hugely subjective other models, things like Totem, where a group of banks would basically all submit exactly the same price valuation for their interest rate options, and the failures in that which caused huge losses on recognition of actual sale. So for the past, as long as I can remember in near history, we've been moving towards being a benchmark contributor in most of the Asian markets. Not true in Japan, but certainly in Singapore, in Hong Kong, in Thailand, in Indonesia. And so we've been marketing the overnight pages in most of these centers. We're a benchmark contributor for Thai baht fix as well. And so creating the life cycle for us is to firstly be a contributor, and then the instruments that come off the back of that benchmark, we also publish in indicative prices in the hope of gaining interest, so that the interbank traders can feel comfortable in making orders in that instrument. So it's a process that takes quite a long time. When the instrument does eventually get executed, it needs to be able to be delivered into the risk management systems of the institution. So, the feed needs to go into systems like Murex, etc. And then there needs to actually be a decision to trade. In this case, and in most cases, it's like an exchange launching a new contract. A couple of people will trade it, because that's what happens in the initiation of a new instrument. It takes some time after that for it to become the standard, for it to be where all the liquidity is in that market. In this particular case, it will need everyone to build their systems and to map this new instrument into their risk management systems to appropriately manage it once they hold it on their books. So yeah, Thailand. Yeah. We did the first overnight trade in Thailand, well, 2-year trade off the overnight index. We did the first Honia trade in October, November last year, about 18 months after publishing the indicative prices. So it's there's a long lead time for people getting comfortable with the pricing in an interbank market, but there's also a lead time in terms of building the back end process for the executed trades themselves, to be able to be valued in the dealer's books.
Thank you, James. It sounds like tradition is playing a big role in the market development aspect, which is the key component of the LIBOR transition. Turning to Dennis for a minute, I know that Bloomberg has sort of appointed the sort of publisher of a number of these rates. I wonder if you could talk a bit yourself about some of these sort of market development aspects that Bloomberg is working on, and how that contributes to the LIBOR transition.
So obviously, the way we approach the LIBOR transition topic or as a project, I think Natalie kind of mentioned this in her answer as well. At the maybe first 2 years old, when we're talking about this topic in probably 2018 or 19, it's all about awareness and education. Even though we are not like a full-blown consultant, but we still try to give clients a little bit of advices in terms of considering their whole like system infrastructures, like operations, business, etc., where they should start looking into potentially the impacts of LIBOR transitions. So we feel like the tone of our engagements with clients this year has actually shifted a little bit, probably because people are now kind of scared about approaching the deadline. So there are actually more questions on exactly what they need to do from a solutions perspective. So typically what we would, in our interactions with clients, we wanted them to kind of like outline a couple of things. LIBOR is such a broad topic. It actually impacts a lot of different business lines. Could be your trading business, maybe your consumer lendings and loans business. And it also impacts multiple systems as well, front-end system, back-end system, etc. So we are typically asking our clients to actually ask themselves a question on, were they able to identify where LIBOR actually impacts on all of their operations and systems as a starting point? And typically, when we speak with different market participants, banks, etc., for example, the more we speak with them, we realize the more these markets now tend to realize what some of the challenges are, and then they are willing to work with Bloomberg to address some of these gaps. So one of the examples is we work very closely with Tradition, for example, in terms of securing the new contributions that they are making in terms of any swaps on that references the new risk-free rates. So we wanted to make sure that there is actual market consensus on the conventions, the calculations, methodology, etc. This is important because without understanding all these underlying conventions, etc., we can actually enhance our prices to actually take in these new data and the curves. And through these exercises, we're also kind of explaining to our clients as well, regardless of whether they are looking for a vendor solutions or they are trying to enhance their own in-house systems. These are some of the exact same considerations that they need. Having to kind of give a reality check with the client, saying that yes, on one hand, there has been a lot of criticism in terms of there is a lack of market conventions and consensus in terms of how these new trades would operate, but at the same time, someone needs to do some of these test trades to actually test the water, see whether from an operation perspective, whether these trades would work, go through like an entire process from the front end system all the way to the back end and risk system, and see whether these conventions and these assumptions make sense. So that's something that we're all working alongside with our customers as well. And one observations that we tend to see is, again, even though we are speaking to like specific teams within, let's say, a financial institutions on LIBOR, even though we probably are already speaking to some of the subject matter experts, let's say maybe in the loans space, for example, just use this as an example. So they probably would know very well in terms of how they operate the loans business, how they need to rewrite the draft language, etc. But what they probably don't have is the mindset of, from a valuations impact perspective or calculations perspective, how would the changes of LIBOR will actually impact their business. So in some cases, we're actually helping our clients to line up internally as well. Like, you know what, probably the teams from your treasury trading team actually knows a little bit better in terms of some of these impacts on valuations, etc. Maybe you should speak with them, and then they can give you some advice in terms of how that formula of the business will be impacted. So it's kind of an exercise helping clients to actually pull in all these internal resources as well. Probably some teams or each team would have something to contribute, and it's a matter of actually forming kind of like a task force together internally so that they'll be able to address these challenges holistically.
Thank you so much, Dennis. I think you raise an important point about sort of the internal communication within sort of individual firms and making sure that sort of the governance practices are there in place. Now I see Jing from the head of legal for Asia Pacific at ISDA has joined us. Just a quick introduction, and I'd like to give her an opportunity to kind of talk a bit about some of the ISDA initiatives that have kind of pushed forward the LIBOR transition. So Jing has previously worked at Credit Suisse, Allen Overy, specializing in OTT derivatives and structured finance. And yeah, as I mentioned, ISDA has been one of the leading voices in the LIBOR transition. I wonder if Jing, maybe you can kind of give us a quick update on, I know you've done a lot of consultation work with the industry, you developed a lot of guidance and documents. Could you just kind of give us a quick top-level update on where industry progress stands at this stage and what comes next?
Yeah, I should apologize first for running late to us because I was had issues of getting into backstage, so I was one of the audience listening to you guys talking. Thank you for inviting me to speak. So yeah, as you are aware, ISDA is implementing fallbacks based on risk-free rates for LIBOR and other key IBORs in our standard definitions, and has held several market consultations to address the differences in the event the fallbacks are triggered. So just to start with, why are changes to fallbacks necessary? The current fallbacks under the 2006 ISDA definitions, which parties use when trading interest rate derivatives, typically require the counterparty, that is a calculation agent, to obtain quotations from major dealers in the relevant interdealer market. So if an IBOR has been permanently discontinued, it's likely the major dealers would be unwilling or unable to give such quotes. It's also likely the quotes could change materially across the markets. So that's why, OSSG wrote to ISDA back in 2016, asked ISDA to improve the contractual robustness of ISDA definition booklet. So let me start with what rates have been chosen as fallback rates for the IBORs, and what are the IBORs being covered in the coming ISDA IBOR supplemental protocol. So the fallbacks will be adjusted versions of the risk-free rates identified by the public and private sector working groups in each jurisdiction as alternatives to the IBORs. So for example, in Australia, this will be the RBA cash rate, and for Hong Kong, it's HONIA, and for Japan, it's TONA. So for US dollar, it's SOFA. So ISDA, I think Dennis probably has already covered it. So ISDA selected Bloomberg Index Services Limited as official adjustment services vendor to calculate those IBOR fallbacks. So the 11 fallback rates will be published by Bloomberg for each IBOR and specific tenor. So the SOR fallbacks will be published by ABS, which is the administrator of the Singapore Swap Offer Rate SOR. And the Thai baht fixed fallback rate will be published by Bank of Thailand, which is the administrator of the Thai benchmark. So altogether, the East IBOR fallback supplement protocol will cover 13 floating rate options. Just to have a little bit more detail on why Thai baht fixed and Sing dollar are traded differently. So this is because there's a number of key Asian benchmarks. There are FX swap implied benchmarks. So for example, SOR used in Singapore represents the cost of borrowing Sing dollar synthetically by borrowing US dollar for the same maturity and swap out the US dollar in return for Sing dollar. And is calculated based on actual transaction in the US dollar SGD, FX swap market, and US dollar LIBOR. So when US dollar LIBOR is no longer available after end of 2021, then the future of this FX swap implied benchmark is in doubt. So we know Singapore, Thailand, India have all set up their respective national working group to look at the local benchmark transition issue. So in Singapore, ABS and the Singapore FX Market Committee have identified the Singapore overnight rate average SORA as the alternative interest rate benchmark for SOR and have set out a roadmap for the transition. So for new Sing dollar interest rate derivatives, the steering committee for SOR transition has recommended use of SORA. But for legacy trades, after conducting thorough review, the committee has recommended adjusted SOR is the most appropriate fallback for legacy SOR contracts. So ABS will calculate adjusted SOR by replacing US dollar LIBOR with its fallback rate published by Bloomberg when dollar LIBOR discontinues or ceases to be representative of the economic reality. So that's why, Thai baht fix is similar to SOR. That's why we have different administrator publishing the fallback rates for the two rates. So I will leave to Dennis to talk about the fallback adjustment and what that means. So the question I want to cover before I hand it back to you, Manesh, is to talk about how this will be implemented and what's the timeline we're looking at, because we're getting a lot of questions regarding the timeline. The adjusted IFR in the relevant currency would apply as a fallback following a permanent cessation of the IBOR in the currency. So for derivatives that reference LIBOR, SOR, and Thai baht fix, the adjusted IFR in the relevant currency would also apply as a fallback following a determination by the FCA that LIBOR in the currency is no longer representative of its underlying market, even if it continues to be published. So ISDA will publish a supplement amending the 2006 ISDA definitions to incorporate the new fallback. So those changes will automatically apply to cleared and non-cleared derivative referencing the 2006 ISDA definitions that are executed on or after the date the supplement comes into effect. And a protocol will also be published that will enable market participants to incorporate the revisions into the legacy non-cleared derivative trades with parties that also opt to adhere to the protocol. So parties could also agree to incorporate the new fallbacks by bilaterally amending their legacy non-cleared contracts. And the clearinghouses have indicated they will use the powers in their rulebooks to implement the fallbacks in all of their legacy cleared derivatives transactions as of the effective date of the updates. So regarding the timeline, ISDA is planning to publish the supplement and protocol very soon. The actual launch of the IBOR fallback documents remains subject to and will occur only after the ISDA receives a positive business review letter from the U.S. Department of Justice and similar feedback from competition law authorities in other jurisdictions. So ISDA will provide market participants with around 2 to 4 weeks notice of the official launch date and the later effective date. So the later effective date will be likely to be 3 or 4 months after the launch date of the ISDA IBOR documents. So I will stop here and hand over back to you, Manesh.
Thank you so much for that update, Jing. And importantly, the fallbacks, I think they're meant to apply really for the contracts that sort of, I guess you could call them as a contingency plan or sort of emergence. You're not wanting to see every contract being closed out with a fallback. You'd rather have market participants switching over into the new contracts voluntarily. I was speaking to you, James, the other day about this and some of the work that you're doing sort of to help the industry transition over to these new rates. And that involves a lot of the products or instruments that you price at addition. Can you talk to us a bit about that?
I think it's just a bit of a carry on from where Dennis was before. It's critically important for the IDBs, of which there are only really 3 in the world now in every market, to adopt the same pricing methodology for everything that they publish in terms of prices, so it's uniform. So any of the market participants can choose that source of data. We do work with Bloomberg from the inception of almost the inception of the ideas of these contracts, so there's an indication of where people might want to trade. We start the process with indicative orders, etc. And like I said, it can take up to a year to execute a trade on something that's a new instrument. And one of the reasons for that is that even though we're publishing the prices on Refinitiv, on Bloomberg, and in some cases in direct feeds to banks, and that might then be seen on the screen of the trader, until it's connected through into the risk management system, right down really to the point of, I know they add margins on and whatever, but right down to the point where you're looking at contract initiation to work out whether the bank should actually go into this contract on a corporate basis on a particular benchmark. Until that full connectivity is done at the bank, and an interdealer market only really works where there's a minimum of 6 major banks. So you're talking about 6 banks building sort of the price dissemination and the instruments into their system, and then the price dissemination that goes from us through the likes of Bloomberg into their systems. Until that's done at 6 banks right the way through their value chain, it's really hard to move over. And this is why the fallbacks are such a big deal, because to get that critical mass of trading activity, the banks need to do a lot of work in terms of mapping these prices, of building the new instruments in their system. And they're not perfect. They might look awesome from the outside because they've got the same logo outside each of their offices around the world, but they're discontinuous departments and systems, some of them for Chinese walls reasons, some of them because of acquisitions. But the point is that it's not a homogeneous environment internally. So that's why right now there's a lot of focus on fallbacks, because I don't think that anyone believes in, across all of the new benchmark products, that there's going to be sort of complete and liquid trading in everything and in every tenor of that particular instrument. Some of them will become liquid quickly, but others won't be. And that will be because of the limitation of building the critical mass in every bank's value chain.
Thank you, Jay. So I guess ultimately what you're saying in a way is that a lot of the transition is in a way reliant on a lot of the very large institutions that I suppose are still perhaps stuck at the stage of implementing internal change, operational difficulties and so on. I was wondering, maybe Dennis, you might be able to talk a bit about that, seeing as you probably deal with some of these institutions, but in particular, seeing as this is intended to be a RegTech conference. I wonder if you could speak about it from perhaps a data and technology perspective and some of those challenges that you're seeing banks face.
Sure. So I'll speak about maybe perhaps the data piece. James already mentioned it already, and it's important from the IDBs or maybe from some of the biggest banks in the market to actually be confident and start making market sense of these quotes. Regardless of whether it is indicative or not, they just need to start the process, because if they never start quoting or pricing on something, they can never stress test the system and see is the system ready or not. So that's, I know I'm oversimplifying things. I know there's actually a lot of considerations, calculations going behind the scene, but it's just a reality. Like you just have to start quoting, trading some of these and stress test your system. From a technology perspective, and this is the same questions we are almost always asking, even for some of the biggest banks as well, which is, yes, they are aware that in order to trade these new instruments based on the new IFRS, they will have to upgrade their system prices and whatnot. But the true question is, when is it going to be ready? And the more important thing is how flexible, when they're thinking of a future solutions, how flexible are these solutions to take into account perhaps new developments in conventions and on all the way and how maybe the curves are constructed. On some of these market quotes are looking at how do you actually look at different maybe day counts, looking at like look backs, etc. The reason for that is because a lot of the banks were telling us that as much as they know that it is a critical project that they need to work on, they are afraid to actually spend too much time and resources to just build their solutions on one particular direction, because they just kind of like fear that there is a risk if, let's say, they've already put all their eggs in one basket and let's say go for one direction in terms of market conventions, but in the end the market decided something else, then they would be like, perhaps they would have wasted their resources and time in building some of these efforts. So there's still a lot of these mid to smaller size banks that we speak with still wanted to kind of like wait and see. So the message that we are telling some of these banks is, yes, we know the resources burden is actually huge. And in the meantime, you need to at least do the bare minimum and then try to think about, as I mentioned, in terms of the flexibility on whatever solutions that you are developing, whether you could actually be like going through different directions. So as long as the market has some sort of like consensus on how these calculations or quotations would look like, then the system will be able to ready and go on to that. So that's something that we are advising our clients to look at, basically, is to look out for flexibility, regardless of, again, whether they wanted to look for a third-party system or something they have to do in-house. It's something that they have to consider. So in some cases, and some of the customers that we speak with, they realize that their core banking system or the pricing systems would not change because of LIBOR. It's only maybe some of the calculations part that they need to change. Then they have to be open-minded about perhaps opening up their systems to actually take in some like third parties helps in terms of mitigating like the gaps or to bridge in between when their system, full in-house system is still not fully ready yet for the entire transition project. They need to find kind of like a stopgap solutions in between to actually help them to run some sort of like impact analysis, potential pricing scenarios, etc. So they have to be a little bit more open-minded in terms of taking in new technology on considering these challenges and valuation impacts.
I was just going to say, it's an interesting point that I noticed this certainly, that some of the banks that maybe sort of, I don't know, it's weird to call banks mid-tier when they're global, but some of them have sort of fully outsourced trade risk management systems. Yep. And some of them are fully internal. And it's at times like this, those banks that fully outsource or partially outsource their trade and risk management systems actually in a better position. Because the solution can be built to approach the whole market, and then it can be rolled out on a sort of an ad hoc basis depending on the client demands. Those that have invested a huge amount of time and energy in building their own systems, they seem to have, it takes them longer to build the inertia for these sorts of changes. So counterintuitively, it's the medium-tier banks that are actually able to react faster to these particular changes.
Thank you for raising that, because I've also heard on this side, you know, as part of our regular coverage at Regulation Asia, that sort of the GSIBs and DSIBs type institutions seem to be, I suppose, more advanced in terms of their governance. However, they also are burdened by legacy systems, so they have bigger challenges and more exposures to face. So I guess for the smaller institutions, I want to kind of identify, and that was kind of one of the keys of this session, to try to identify some of the technology solutions that might be available. So whether there's an outsourcing component, technology solutions that kind of, you know, might come in and sort of save the day, I suppose you could say, as we kind of get closer to the deadline. Natalie, do you have any views on some of these technology perspectives or solutions?
Yeah, look, I don't know that there's one technology solution that's going to come and save the day. I mean, the technology sort of aspect, it depends really on what you're looking at. I mean, I think we've identified, obviously, there's a legacy issue here, and then there's the sort of the new products and that are being written as well. And I mean, if we're looking at the legacy issue, there's obviously the repapering exercise that needs to be done, and that is somewhere where technology can absolutely assist to identify clauses in contracts that need to be amended, using sort of AI, capability in various software programs. Also, in order to be able to then insert, the solution once we've decided on exactly what that is. So technology really plays a big part. At the moment, it's a balancing act in terms of having a look at your legacy exposure, and also to the new, looking forward to using the new alternative reference rates. And each comes with their own risks. I think the point that James made around, and Dennis as well, it's a little bit of a sort of chicken and egg in a way, and or even a game of chicken, and nobody sort of wants to go first, and a lot of waiting for the market to go first. And so I think the technology solutions, a lot of them are there and being developed, not necessarily being deployed at this at this stage, because the inputs and that are still to be decided on.
Yeah, I think that's one of the interesting points about this. When other regulatory change requirements come in, eventually you expect a technology provider to sort of have something there, tailor built for that particular problem. Listen, we're sort of running out of time here, but I thought maybe if we could just go around and have each of you maybe spend 30 seconds or so just kind of describing what you see as the path forward, what really needs to be done to address some of these challenges. Perhaps we can start with you, Jing.
Or 30 seconds. I think the key is that when ISDA launch the protocol and supplement, please do take a look of the ISDA protocol and adopt the IBOR fallback language, which is very important for the robustness of your existing LIBOR contracts. And when you talked about the IT issue, so ISDA create and ISDA amend will also be used to facilitate parties, adoption of the contractual fallbacks. One thing I would just mention, if anyone is particularly interested in this benchmark transition issue, ISDA will be running conference on September 16, which is complimentary, free for and open to everyone. And we will have HKMA, MAS, and RBA joining us and give keynotes and also discussing the LIBOR transition issue together with market participants. So please do, if you're interested, to register for the ISDA seminar.
Thank you, Jing. Dennis, any final thoughts?
Sure, a couple of things. So first of all, ISDA fallback rate is already live. We already started publishing since July. So if you're interested to find out, it's available on our website or on the Bloomberg terminal. Second, I wanted to highlight the key point I was talking about in terms of considering the flexibility of whatever system that you are choosing. Again, whether you are thinking of developing this in-house or looking for a third-party house such as Bloomberg, think about the flexibility of these solutions could provide to you. So in case the market goes into different directions in terms of development, you'll be ready for that. And I want to echo on Natalie's point as well when you're thinking about repapering. A lot of our discussions today is focusing on, on derivative side of things. But don't forget about your floating rate notes, your loans, and maybe some of your securitized products as well. They all have LIBOR components linked to it. There is actually lesser degree in terms of market consensus in terms of how these fallback would operate. So it's important for you to take a first-hand information to just figure out for the exposures that you have, what are the actual fallback languages that has already been written inside the existing terms and conditions. Because if you're just waiting for the banks and issuers to tell you that's their proposal in terms of how they want to change the fallback, you probably won't have enough time to consider whether their proposals make sense. So do take the time in advance to actually start looking into these fallback terms if possible.
Thank you, Dennis. James, final thoughts?
Yeah, I mean, mine are a bit more sort of general. My opinion is that all of the banks and trading institutions should adopt the approach where putting a new instrument in their portfolio is done on a life cycle and on a value chain basis, so that whatever it happens, if you issue a new loan with a different basis, it feeds all the way through up the chain so that you can trade it in the interdealer market. And the same conversely, if there's a new instrument in the interdealer market, or it has different criteria and the criteria change, which happens in the futures market often, that it's easy to feed those changes back through the whole value chain. So I agree with Dennis, you've got to be flexible, but the business should be built around the constant evolution of derivative products. So the idea of adding a new instrument and changing the basis on which you do the valuation all the way down to the original loan, that needs to be part of the business plan, not just like a one hit that we got to get to by the end of 2021. Otherwise, when's the next stage of evolution going to occur?
Thank you, James. Would have liked to explore this a bit further. Natalie, final thoughts?
If you're not already looking at this, get started. It will take you a lot longer than what you probably expect. I think it's important to have good governance around it, to document the decisions that are being made and why, certain approaches and that are being taken. And then I think the final thing is you need to get, all the different parties on board in that with the strategy, sort of both internally and then from sort of an external perspective, whether you're, working with advisors, vendor solutions, software providers, etc. So communication then becomes really key. So, and having, I guess, everybody sort of working towards the same aim, because there's enough uncertainty as it is without having people going in different directions. So
yeah, thank you very much, Natalie. And with that, we're out of time. I would like to thank our panelists, Jing, Dennis, Natalie, James, for an interesting discussion. We didn't cover nearly as much as we had intended, but in any case, it's clear that progress has been made in this transition, but there is a lot more work to be done. And it's, there's no quick fix technology solution as yet that can kind of help, that can kind of speed things up too quickly. The work needs to be put in. Anyway, we'll continue to follow this issue closely at Regulation Asia. Thank you to all of our attendees for listening in. Thank you very much.
Thank you.
Bye.
Thank you.